Hi, everybody. Scott Riley, the Market Update Desk, powered by Mortgage One. March 6th, kind of the second update for the day. We did a quick one this morning via Instagram on what the initial ADP payroll numbers were. Wanted to go into more depth with that and the other items affecting us today. So let's kind of break everything down for you here. Chairman Powell came out and did his speech that he had pre-prepared for Congress. Nothing significantly new came out of that. It was a reiteration of what he's been talking about. Said that the labor markets remained tight, but supply demand came into better balance and inflation has eased, notably, but remains above their stated goal of 2%. On a monetary policy, he did say that it will be appropriate to cut some rates this year, but does not have enough confidence that inflation is moving sustainably to their 2% goal. What does that mean? We're probably going to get two cuts this year, 2 quarter-point cuts probably in the middle of the year before full election season. Not nearly what the market was really planning on back at the end of December when we got the jobs report and inflation numbers that really helped us out. Now, his Q&A session that is going to be this afternoon, we do have to watch very closely because there's a lot of aspects to that that could be market moving because it's more off the cuff than prepared statements. So breaking down the entire ADP report today. So came in at 140,000 jobs created. Market was expecting 150, so 10,000 less. Now, the interesting thing is where some of these jobs came from. A little bit unexpected. The lion's share, 61,000, came from large companies, and that's designated as 500 or more employees. Medium-sized companies came in at plus 69,000. That's between 50 and 499 employees. Small businesses had the smallest portion, 13,000. It tells us that this economy is definitely making it harder on smaller companies, especially with wage pressure. Now, within those industries, the leisure and hospitality grew by 41,000 jobs, trade and transportation by 24,000, and construction was up 28,000. So hopefully we can get some more construction going is what that really is going towards, which would be nice. Annual pay increases, we touched on that this morning. For job stayers, the average rate of pay increased by 5.1%. For job changers, increased by 7.6% year over year. What we're seeing is a slowdown in wage growth. Both the stayers and the changers saw less growth than what the market anticipated, and even more so for job changers. Back 2 years ago, when we were in the height of COVID, you'd see job changers have 12, 14, 15% pay increases. So we're starting to get some more stability in that aspect. Neela Richardson, the chief economist for ADP, indicated job gains remain solid. Pay gains are trending lower, but are still above inflation. So we're going to watch this really close. Now, the interesting thing with ADP, it only covers private payrolls. When we get Friday's numbers from BLS, that does include government payrolls. So a lot of these job gains we've been seeing are government-backed jobs. And the disconnect between ADP and the BLS has been very prominent. So we're keeping a close eye on this. Now, with ADP, the data is probably more true than what the BLS is because of all of the imputed models and adjustments that the BLS does versus ADP, which is just raw data. The other report came out today was the JOLTS report, Job Opening and Labor Turnover Survey, showed that there were slightly less job openings. December was also initially reported at 9.026 million. That was revised lower to 8.9 million. Now, the January fell further to 8.863 million job openings. So we're seeing what we've talked about, most likely contraction within the jobs market and reduction in wages. A lot of what the Fed wants to see, but we're just not seeing the results from the Fed with reduction in the interest rates or with the trimming down of the balance sheet reduction. Those are things we're really looking for. The ISM services index came out today, and that fell to 52.6 index from 53.4. less than expected. I'm sorry, more than expected. Now, the estimates was 53. Within the report, though, the prices paid, which is an inflationary component, fell down to 5.4 points to 58.6. While it's still above 50, which is the trending line, it's a big decline and is in the service sector where we are seeing most of the inflation. So hopefully that's going to start to wane. The employment component fell to 48 index from 50 and a half. And this is the second month in the past three that have shown an index of below 50. Now, that's another point of evidence of a slowdown in the rate of hiring. Now, on good news, Blask Night came in and reported in home appreciation rose 0.2% in last month and was up 5.6% year over year. So we're continuing to see home appreciation gains. Some very important things on the technical numbers. The mortgage-backed securities have broken above their 25-day moving average ceiling and are now, looks like, on their way up to the next level of resistance, which is the 50-day moving average. That means potentially better mortgage rates. Great thing. The 10-year bond confirmed that its move beneath the 200-day moving average and is now trading just below the next floor of resistance, which is the 50-day moving average, which is 4.10. So some very interesting things going on. Everything's going to hinge on Friday's BLS jobs report. Let's hope that we get more true numbers, not adjustments, not imputed numbers, not games with the birth-death model. So give us a call, the Market Update Desk, your singular market knowledge source for the West Michigan area. Give us a call. We'll help you get pre-approved, help get some offers accepted. 616-293-2189. Thanks.